Hey everyone, welcome back to the Canadian Real Estate Channel. This is episode number 2 of our Real Estate Roundtable. We've got another great slate of guests for you guys. We're going to be jumping into all sorts of different topics. Obviously, the first topic we're going to be exploring is the Bank of Canada's recent interest rate announcements. In case you guys somehow missed that, we'll be diving into the 50 basis points increase. But before we get around to that, let's first introduce all our different guests here. Let's start off with Emma. Hey Emma, how are you doing?
Hey, Matt, I'm doing well. Good to see you again.
It's awesome to see you as well. And if you don't mind, introduce yourself in case someone hasn't caught your previous YouTube videos here.
Yeah, totally. So I've been a guest on the channel for many years now, actually,
Yeah.
and I run a real estate team in Toronto called Monstera. We specifically focus on helping millennials build wealth through real estate, and I've been investing in real estate since 2016.
Awesome. Well, I'm excited to get some of your thoughts, your opinions on all this, but we'll first introduce a handful of our other guests here. Hey, Chad, how are you doing?
Hey, Matt, I'm doing really well. Fan of the show for the long time, so it's an honor to be a guest on here as well.
Awesome. Well, we're excited to have you. And if you don't mind, just give a little introduction about yourself.
Yeah, so started in the real estate industry in 2004, did residential for a year, moved over to industrial real estate in 2005. Been at the same company ever since. In 2014, I started investing in industrial real estate myself with some partners. We've accumulated a portfolio of about $20 million right now, and we've got another $6 million property under contract. And as you can appreciate, interest rates have been an interesting conversation surrounding our due diligence on that one.
Yeah, I'm sure that's something that you really need to stay on top of. And if anyone has any questions here, I imagine industrial and $20 million portfolio probably peaked a few ears on this. So jump in the comment section in the second half of the show. We'll be getting to all your questions and comments, guys. Let's now jump over to Josh. Hey, Josh, how are you doing?
I'm doing great, man. I've actually been a big fan of the channel since just a little bit longer than Chad and just a tiny bit bigger fan than him. But yeah,
Awesome. Well, we're excited to have you here, Josh. And if you don't mind, give a little bit of context about your real estate background.
absolutely. So I'm a life coach based out of Windsor and also Toronto. Lifelong practitioner of the FIRE method, financial independence, retire early, something I've seen you advertise and give great voice to on your channel. So that involved house hacking as my first purchase, and I was never really a comfortable renter. So I got myself into a distressed duplex, added a unit to that, did my best to pay that off as quickly as possible, and got my hands very dirty and repeated that as quickly as I could. So because of this great market rally, I was able to do that with just 4 properties. And between that and my own business, achieve full financial retirement by 35.
That's awesome. I love it. The Freedom 35 plan. Finally,
Beautiful.
we've got Abigail. Hey, Abigail, how are you doing?
Good. Thanks for having me.
Awesome. We're excited to have you here. And if you don't mind, just give a little introduction.
So my name is Abigail. I work with REC Canada, powered by Real Pay Signature. Been investing in real estate since I was 19 years old. I have 4 properties and counting right now, and my goal is to be able to help people build wealth through real estate. Been doing that online through my Instagram and my TikTok, and I've definitely been having a lot of people follow me and be able to educate so many people that are in my community as well.
Awesome. That's great to hear. All right, guys. Well, we're going to jump into the number one topic that everyone's talking about in real estate these days, not only just because the Bank of Canada had a recent interest rate announcement, but just because we've seen 6 rate hikes now this year alone. So I'm going to pull up this article from Better Dwelling. Bank of Canada hikes rates just half point, economy not strong enough. Canada's central bank surprised the market with a weaker than expected rate hike. Bank of Canada, BOC, raised the overnight rate 50 basis points, hitting 3.75%, the highest in over a decade. It was double the typical pace, but the increase was still smaller than the market had priced. The central bank confirmed the market's suspicions. The economy is weakening. Despite rates rising at a slow rate, inflation projections are also falling. The Bank of Canada's average inflation forecast fell to 7.1% this year, down 0.4 points. In the previous one, they now see headline inflation hitting target by the end of next year. It appears they're indicating slow growth will help cool demand. So the Bank of Canada warns this isn't peak. More hikes are coming. And I think that's a great spot to start off here. So I'd love to hear from you guys. What are your thoughts in regards to where interest rates are right now and where they're likely to go? And I know we talked about this briefly last week with our other group of panelists, and I'll just share my thoughts here first. But essentially, when it comes to interest rates, I'm going to believe the Bank of Canada right now that this isn't the peak. I know we've seen a lot of economists, particularly like mainstream economists, come out saying they think we'll likely see a peak in, say, January or February of 2023, and that we'll likely find ourselves here in Canada, at least, probably around the 4.5%. I've seen a lot of American economists predicting 4.75 is kind of the peak they're expecting. But I'd love to hear from you guys. What are your current thoughts, and how is this personally impacting you, or is it impacting you at all? Let's go with Emma, because I don't see anyone unmuted yet.
Yeah, so I mean, look, on the on the agent side of the business, of course, we've seen the market cool. Like the continued interest rate increases have obviously had an impact on the overall market. But I agree with you, Matt. I think we're probably still in for a couple, further rate hikes. That said, I think from a market sentiment perspective, I think there's a segment of the market that has kind of digested the fact that this is just the new reality when it comes to borrowing costs. And so I think there's a portion of the market that is still, somewhat resistant to taking action given the fact that borrowing costs are much higher. And I think there are some people who have a larger appetite for participating in the market given the current borrowing cost and at the end of the day, baked in price reduction at this point in time. So I think we'll probably see prices slide a little bit further. But I don't think that the demand or desire to own a home or purchase real estate has gone anywhere. I feel like it's just kind of been delayed and continues to get delayed. But my thoughts are, once we start to see the market sentiment, or at least the future pacing of the media's predictions or the Bank of Canada's predictions, that things are going to halt, not even necessarily go down. I think we'll probably see a decent number of people jump back into the market. Like, there's a lot of people waiting on the sidelines, as far as I know from my the six of us having regular communication with the general marketplace.
Mm-hmm. Let's jump over to Josh next, and then we'll hit Chad.
I think Emma's sentiments kind of hit the nail on the head, which is to say there's a lot of people waiting on the sidelines. But that also means that we're seeing a lot of attrition in the market already, and I expect that to stay. So I think your call, Matt, is exactly right. We've got a very strong indication from the Bank of Canada itself. Their rates are going to continue going up at least a few more times, and at least for a little while, which means that seasoned investors are waiting for a bit of an opportunity to come, and inexperienced investors in that perpetual bubble of everything's going to crash have every reason to have that hope. So for me in specific, I'm actually already experiencing this attrition and the changing sentiment in my own career, because I was hopeful to sell in late spring. And with this market, I've obviously become very content to sit tight if that's what it takes. The rising interest rates have taken a lot of the fervor out of the buying pool, which means that properties like mine, which sometimes have non-conforming elements, have lost some of the most ambitious buyers and perhaps aren't worth marketing right now at all.
Yeah, that's definitely a great point there. That, again, some of those edge case properties won't necessarily get the same sort of love as they probably would have in the peak bull. Chad, what are your thoughts on interest rates? And as well, if you don't mind, share a little bit of perspective. What's that look like when it comes to industrial real estate as well?
Yeah, great question. And I agree with what Emma and Josh had said already. There's more increases coming down the road. I think Bank of Canada and south of us, the Feds have made that very clear that they're going to keep rising interest rates to tame off inflation. The challenge, as I see it, is they're trying to manipulate a leading indicator in interest rates to affect a trailing indicator in inflation. And I suspect that they're going to overcorrect on this. I think that the inflation numbers will come in too late. And then at that point, we'll probably be into some recession. And then I would anticipate, like we always see, the cycle of interest rates is they'll probably lower interest rates to try and get a handle on it. So I don't envy the Bank of Canada or the Feds all across the world. They're trying to tackle two different problems at the same time. Interestingly, I'm finding that banks have already priced in a certain amount of increases, and just anecdotally, like, really interesting on the industrial side. We've got a roughly $6 million property under contract. Our rate yesterday, and we just about locked in yesterday at 5.8, like give or take 5.8. After the announcement came out today at 50 basis points, they actually dropped it to 5.4 and change. So they were already
Oh.
pricing in a considerable amount of increase that the Bank of Canada was suggesting. And I see this all the time too. And I'm just an observer, but I've got skin in the game. So I guess I'm a little bit more of an observer. I see that the Feds and the Bank of Canada try to indicate to the market what they're going to do in advance just to get the market to adapt to it. And then they must evaluate the reaction and make their decision accordingly. It's like this supreme puppet master that's just using us all as pawns to see what they're going to do. I was surprised that it was only 50 basis points today. I thought with inflation numbers coming in the US, it was the last month was 8.2%, and even core inflation was 6.7. I think we mimic a lot what happens in the US. So I was surprised that they only raised it 50 basis points. That article that you brought up mentioned that the economy might not be doing as well, and I think that that's really worth watching. As these inflation numbers, it's a trailing indicator, so we might not have a really good sense of what all these interest rates are doing. And it's over 300 basis point increase this year alone. Like I in my entire career, I've never seen an increase this fast over or such a short period of time. So I suspect that people will adjust. They will make adaptions, but it's going to take time. It's not just going to be interest rates go up 100 basis points or 50 basis points today and people make decisions that day. This is going to last a while. So I think that this will be a story that we're evaluating for the next 6 to 12 months, and it's anyone's guess what it's going to look like this time next year.
Yeah, and I agree with you. Had I been forced to bet, I would have bet on likely 75 basis points for this round. And honestly, that's kind of what had been telegraphed to us by a lot of economists as well. But it is interesting to see the constant balance that the different central bankers are trying to do here by both sounding hawkish enough to try and get inflation under control while still being a big enough dove that hopefully the economy doesn't completely implode or find itself in a recession. Abigail, what are your thoughts in regards to where interest rates are now?
I agree with what everyone else has been saying. Honestly speaking, I think everyone's right now are waiting on the sidelines, like Emma was pointing out beforehand, and everyone's waiting to get to that bottom where they can get the best prices, the lowest prices. But it's like we're not going to really know we're at the lowest prices until we get to the lowest price, and that's the thing that's going to suck up for a lot of people that are waiting on the sidelines. So for me, I always tell a lot of my clients, like, listen, if you're planning to get into the market and hold it for 5-10 years, you're still going to win right now, right? We understand that, we were at our ultimate lowest in terms of interest rates for 2 years. And then the interest rate hikes just went really, really fast to a point where a lot of people were kind of in shock. So I feel like it has to take some time for people to get back to the norm of, okay, this is the new norm, 4%, 3%, 5% for interest rates, right? Once that happens and people understand, like, okay, you know what, this is the new norm, we'll get back into that. Like, the real estate market is not going to crash like that. We have to get used to what's happening again, and that's what everyone's waiting for. But it's just that no one has a time machine to see what's going to happen in the future. So.
And speaking of time machines, in a second, I want to hear everyone's kind of predictions on where you think that top is going to be. I'd love to hear your thoughts in regards to both interest rate as well as the timing of that interest rate. But before we do that, just real quick here, Emma, what you mentioned, like millennial buyers, how do you see these interest rates right now, the hike cycle we've been through, impacting millennial buyers? I guess, the big question here is constantly the narrative for the last 5+ years, essentially, is how millennials are being pushed out and priced out of the market. Is this an opportunity for them? Is this the final nail in the coffin here, and millennials will never get to own real estate?
I don't think that's the case at all. I think, honestly, I feel for millennials because they just haven't had a very realistic expectation of the real estate market. Like, if you've been starting this real estate journey over the last 5 years, like, it really hasn't been quote unquote normal if you look at the real estate market over the last 50 or 100 years. So I think a lot of millennials are just confused. Like, okay, is it either just a massive bull run or the sky is falling? And you're like, no, that's not usually what it is. You just kind of had shitty timing, unfortunately, right? So I think it's more it's more education than ever, right? I think everybody, like, my thought process is this: rewind back to February 2021, people would have taken 3 out of 10 on their wish list, right? Like, if they got 3 items of their 10 on their wish list, they would have paid a 10 out of 10 price and got 3 out of 10 of their requirements and would have been happy with that because that was the acceptable norm given what was going on in the market. Now you're looking at getting 10 out of 10 on your wish list at an 8 out of 10 price. But because of the uncertainty that's baked in the marketplace, people don't want to make a move, right? My genuine concern for millennials is when we do see that inevitable shift back to a more bullish market than we're seeing now, the expectations are again unrealistic. And so what I think it comes down to is like really educating the market and making sure that you're being a matchmaker for someone's dream in the future and setting the expectation that like you're not getting your dream home the first time, right? You're getting more features than you've ever got at the price point that you have right now than you probably have in the last 5 years. But it doesn't mean that you're going to get that detached house in Toronto first. You're still starting with the condo. And so it's like building that plan of action in that path and just setting realistic expectations. And I just, again, I feel for millennials because I feel like it's just been really, really confusing over the last couple of years. I'm like, how can you actually make this happen when really it's just following a good strategy?
Yeah, appreciate that insight. And before we jump over to Josh, just want to give a shout out to my buddy Mike Rosehart, who's in the chat there. Appreciate you, Mike. We'll definitely get you on a future episode. Josh, anything you want to add on that?
Yeah, just with respect to millennials, I mean, as a general trend, we might see a big reduction in home ownership, and it's very understandable with the relationship between earnings and the price of houses these days. But to any millennials that are watching, let me say with humility that I am 38 years old, and upon joining Cash Tribe, I've been humbled repeatedly at every meeting to meet people who are 19, 20, 21, and are absolutely kicking ass and during one of the most aggressive competitive markets in history. So I can say almost certainly every person on this panel, from Matt to Emma to Chad and Abigail and myself, was probably told by the majority of our peers in our everyday life, oh, this is not the time to be getting into real estate. And boy, be careful if you're going to start buying these big properties. And I think the top is in and you should just wait and it's going to cool off. And the reality is, if you're trying to wait for the bottom or even wait for a massive fall, you're playing a game of trying to catch a falling knife. The numbers are always the numbers. A deal is always a deal. So if you're watching, learn how to appraise a deal. And if you want to get into real estate, you don't have to wait. Talk to somebody educated, get in touch with people like Emma, move your butt.
Yeah, 100% agree with that. And for anyone that just recently joined the stream, jump in, give us any questions, comments you have in regards to the real estate market here in Canada. We've got a great panel here, but let's pull out the crystal balls and talk about, and obviously no one's going to be accurate with these crystal balls, but we still love to speculate. Guys, what are your thoughts when it comes to interest rates? Where do you think the peak is in regards to pricing as well as timing?
I don't mind taking a stab
Let's
at this
do it,
one.
Chad.
So I wouldn't be surprised if we see another 100 to 200 basis point increase. I just think that'll be very short lived. And I'd also say that nobody does have a crystal ball, and I think everybody in this panel would be on the same page that real estate isn't a short term game. Nobody should really be trying to, unless there's flippers out there. And I understand that they've got a different business model, but for myself personally, my timeline is 15 to 20 years. These short-term aberrations that happen with whether it's interest rate increases or any number of variables, like Josh said that very well, there's always reasons not to move forward on real estate. And it could be the pandemic, it could be rising interest rates, it could be rising inflation, it could be war in Ukraine, it could be any number of things that causes someone to say now is not the right time. And you could look back throughout history and you'll always find reasons on why somebody shouldn't have invested. But you also have to look from the longer term horizon. If you believe that the economy is going to be better at the end of your investment horizon, for me, that's 15, 20-year money. I'm not as concerned with these short-term aberrations as much as I am buying the right property and feeling confident that, and I'm on the industrial side, so a little bit different, but buying from the standpoint that I want to have solid tenants in there that can continue to pay their rents. If interest rates do increase, if I'm on a fixed year mortgage in that short term, it shouldn't really affect me. I do have some mortgages that are coming up in the near future. And from a strategy standpoint, I'll probably just end up floating that debt. Instead of fixing it, I'll probably just take variable debt because I do think that those interest rates will crest, call it another 100 to 200 basis points higher. And then at that point, as they start coming back down, then perhaps you look to fix at that point. But as kind of an overall sentiment, I'm just not as concerned about those short-term fluctuations, because there's always something that's in the news that's trying to scare people away from making decisions. And if that's their prerogative, then that's fine. But you need to accept that if you're making an excuse not to move forward on something right now, you'll find other excuses down the road. It's a tough thing to say, and the last thing I'd ever want to recommend to someone is that they go out on a limb that they can't afford to go out onto. But as I believe as Emma that mentioned, if you can start small and start building some equity, start getting yourself in the real estate game and go into it with those realistic expectations. I'm still a big believer that real estate's going to be a great investment vehicle, but it could be shaky in the next 1 to 3 years. That'd be my guess, but I'm still very bullish for the long term.
Yeah, definitely appreciate that, Chad. And I think it's hard to disagree with you on a lot of those points there. And just because you kind of mentioned your own strategy towards like your mortgage, that feels like a perfect time to jump into Anil's question here, which is, guys, break out the crystal ball, fix for 3-5 years, or ride the variable. I've personally locked up rents. Are fixed. So should your mortgage be? And love to hear from anyone and everyone on that, because I think there is a lot of landlords and a lot of investors that are seeing their mortgages come up for renewal and do feel a little bit lost in regards to how to approach that mortgage. Obviously, we know historically speaking, variable seems to always be the way to go if you're really focused on optimizing the minimum amount of interest payments you need to make. But in the current climate, is that still the case? Abigail, yeah.
Yes, so I'm actually a mortgage agent myself as well. So when it comes down to locking yourself in right now, I honestly, personally, wouldn't really suggest anyone to lock themselves into a 5-year fixed rate, because so much can happen in 5 years. If you're gonna do like a short term, 1 year, 2 year, even maybe 3 years, just stretching it of a fixed rate just to feel comfortable for yourself, and you don't want, payments are going up and down. Cool, that's fine. But anything greater than that, I feel like you're going to be putting yourself in a position that you don't need to be in, because long term wise, we all know it's going to go up and down. Like right now, I expect, like Chad was saying, definitely to see at least 100 to 200 basis points increase, but it's also going to go down eventually. So even with me right now, I'm currently on a variable rate. So I'm riding the wave. Like today's announcement hurt me too, right? But overall, I know that eventually it's going to go down, right? So if I were to get FOMO and then lock myself into a 5-year 5.89 fixed rate, like that's 5 years. And then God forbid, if I have to break that penalty, break it as well, the penalty that I'm going to face is going to be so large. So I wouldn't suggest anyone locking in at a 5% and higher fixed rate right now for like a 5 years. It's like a 1 year, 2 year, that's cool. But anything longer than that, I wouldn't suggest it personally.
Yeah, appreciate those insights.
Abby,
Josh.
before he moves on, I'd actually love to ask, since you're in mortgage broking, what kind of expenses would you expect if someone took the approach of refinancing, trying to take the secure strategy of locking in a low rate, weathering the storm across a couple of years of high interest rates, and then deciding that they wanted to try to refinance and get back at a lower rate? What kind of penalties could people be looking at trying to do a strategy like that?
Well, every bank is different as to what type of penalties they kind of give people, but typically speaking, the variable rates, when you're breaking that, that's the cheapest way to break your mortgage, right? Fixed rates, I've actually seen some people had a penalty of $32,000, $30,000, $40,000, $50,000, right? It depends on how big your mortgage is and how many years you have left in your term, right? So you never really want to lock yourself in, especially if you have a short-term plan to say, like, listen, like, I need to refinance in the next 1 to 2 years to pull up my money that I put in. You don't want to lock yourself in there, because you might eat up a lot of your equity just paying the penalties and the fees in itself. So honestly speaking, like I always tell people, when you're going into real estate, always have a real estate action plan. That's what I call it. Know what you're going to be doing with the real estate product that you have, so you can better strategize what type of product you need, what type of term you need to go for, and stuff like that, so that it's more clear cut for you, so you don't just run into getting so many penalties on you eventually. So that's my opinion on that.
Well
Appreciate
said.
that insight. And Matt, as somebody who's done this game a long time and pretty creatively, do you have some insights on what kind of expenses and costs you would expect trying to do a maneuver like that if you wanted a few years of easy sleep trying to lock in a lower rate, expecting to have to refinance later should the rates come down a lot?
Yeah. So my strategy always was to not try and like minimize, like not try and outsmart the bank at their own game in regards to trying to like minimize my interest costs. For me, it's much more about having a couple different strategies when I'm actually like acquiring the property. So usually, again, like you want to have like a pivot or two up your sleeve in case things change, right, or evolve in the market. And when
Sure.
thinking about approaching like fixed versus variable right now, I I would really be tempted to still want to lock in as long as my property supported that. And again, that would just be me wanting to lock that in and then go get the next deal. And rather than try and like spend all my time looking into the crystal ball, trying to figure out how to maximize my net income on that one individual property, I feel like I could probably spend better time just going and getting the next deal. So for me, I never viewed like getting the absolute lowest interest rate as like my superpower, right? Or one of my competitive advantages. So that's not an area that I spend a lot of time. Now, again, I know Mike Rosehart, he absolutely loves to try and save every single penny he can. I've got no doubt that he would have multiple charts and graphs out. He'd be pitting bank against bank and lender against lender, trying to do anything he could do to maximize his net gain in that situation. There's nothing wrong with that either. But for me personally, I'd always rather just go get the next deal. Part of that is just because the next deal is always fun. It's shiny, it's exciting, and things of that nature. But I think it really does come down to your individual strategy, right? So if you knew you were going to be burning this property, getting a 5-year fixed, and then hoping that magically when it was time to refinance and lever up in regards to the debt and hoping that you weren't going to get hit with a big fee or penalty. I think that that would be a risky proposition right now. But again, in a rising interest rate, maybe you're not going to end up with a big fee if you're going to be breaking in a very short period of time. But I guess in general, my thoughts are like, know what your strategy is, right? Know where your competitive advantages lie, and then make sure you actually understand the fundamentals of the property you're getting involved with, right? So again, for me, it was always cash flowing rental properties. So if right now at the current interest rates, that property is not going to cash flow, I probably just wouldn't be touching it regardless, right? And I wouldn't want to be in a situation where it's like, ooh, I need to make sure that I'm saving 0.1, 0.2, 0.3 percent on the mortgage in order to be able to actually break even or profit. But again, that was always me and my strategy. I've met so many investors over the years as a real estate investor and content creator that I know there's always ways to make money. But this is the only time that I think it's appropriate to quote Jim Cramer. But I do love this quote of his that is, bulls make money, bears make money, pigs get slaughtered. I think that really when people start to get too greedy, that's when they oftentimes outsmart themselves. And I think that that's something that right now you want to be careful about, is that you're not trying to outsmart yourself.
Well, awesome answers. Thank you, Abigail and Matt. And I'll let Emma get her word in on interest rates before I answer that question.
No, I wanted to echo that too. Like even before you just said what you said, Matt, I think like as much as we're investors, like we're also human beings, and you really have to understand what like it's very easy for us to like paint the whole market with one broad brush stroke, but you also have to know what's going to allow you to sleep well at night and to stick to your strategy without freaking out and making like a intermediate change because of emotion. So if like we can take the numbers and we can look at them until we're blue in the face. But if you decide like I'm gonna go with the variable rate and you're gonna lose sleep at night, even if you think it's a better strategy, as a human being, it might be the thing that makes you freak out and change your strategy in 6 months because you just can't stomach you just can't stomach the volatility that comes along with it. So it's very easy for us to be like, do this or do that, but you have to know like who you are as a human being and what are you going to be able to commit to, make that decision and commit and stick with that decision.
Yeah, that's a great point. And I think there's a quote from The Art of War, right? Which is like, know thy enemy and win half the battles, or know thyself and know thy enemy and win every battle. And I think for a lot of people, that's key right now, right? One, understand that you can't literally know what the Bank of Canada is going to do, because pretty sure if you look back, a year or two, Tiff was singing a completely different song than where we find ourselves today. And I suspect that, again, 2 years from now, we may be finding them singing a completely different song. And you can be frustrated by them telling you one thing and then doing the other, or you can actually just make sure that you're focused on the fundamentals and you're preparing yourself appropriately. Have a couple pivots up your sleeve, as we said. But Josh, jump in.
Well, I'm curious, Emma, did you want to do your crystal ball prediction before I answer that gentleman's question and offer my own insights on interest rates?
Yeah, like I honestly I do agree with you, Chad. I don't know if we're gonna get quite to 200, but I don't think I'd put my money on 200, but I definitely think we'll probably see, 100 or maybe north of 100. I don't know how long lived that will be, but I do think we'll probably see a little bit of a tapering off there. And I guess like my crystal ball prediction from a timing perspective is, maybe spring or summer 2023. But I think my prediction is just given the conversations that I'm having, just boots on the ground from like a general consumer perspective, is I think when the market comes back, it comes back pretty hot. Because I don't think I haven't seen the demand disappear. I've just seen it be delayed because of the uncertainty in the market, right? There's very few people that I've had conversations with that have said, I don't want to buy a house. Everyone's like, I for sure want to buy a house. I just want to buy it at the bottom. So I think, unfortunately, and I don't mean this in a rude way, but I don't think very many people want to be leaders. I think people want to follow the footsteps of others. And so I think once the market starts to turn back around and everybody thinks I'm that early adopter in the marketplace, normally you're not the early adopter in the marketplace. The early adopters are people that you haven't recognized that have already made the moves. When you think you're an early adopter, you're usually one of the, one of the larger amount of people that are entering the market at that point in time. So my advice for anybody that's watching this is you don't have to go and make a move right now, but I think you need to be prepared, because one of the challenges that we did have was when the market got crazy, we had to hire all these mortgage brokers for the bank, right? And now things are quiet and they're going to lay people off. And so what happens is when you think you're an early adopter and you haven't got your documents into the bank and the market starts to come back, now you're waiting in line and you're not the first person. So, and if we're short staffed, then we start to get those buildups and delays on getting the pre-approval and getting your turnaround and all of that kind of stuff. And so you can't be frustrated in spring or summer 2023 or whenever the market comes back. I don't know. I don't have a crystal ball at the end of the day. It's just a guess. But you can't be frustrated when the bank turnaround is significantly longer because they're shorter staffed and you didn't get your shit together early enough. So my general advice is you don't have to make a move, but at least be prepared if the right thing popped up that you could make a move, or be the person that has their ducks in a row at all points of time so that you can be the early adopter, because when you think that you're early, you might actually be late.
Sounds about right. All right. So first of all, everybody go ahead and throw your microphones on at any time. I don't mind if when I'm talking, would even appreciate it if you just leave them on, because everybody's got a lot of great points that are echoing a heck of a lot of what other people have already spoken about. So if anybody's got a bunny trail or a side thought on what I'm speaking about, please feel free to interrupt and I'll give you the microphone. With respect to my crystal ball, I think that Chad's predictions are a little more daunting, but perfectly realistic. I don't know if Emma's the better psychic, but she's certainly my preferred psychic. So, seeing 2 full percentage points up on interest rates would be pretty devastating, but I don't think it's out of the question whatsoever. I also think that we don't need a perfect answer to that question to get pretty good direction on what we should be doing. The minute we know the direction that things are moving in with relative certainty, that gives us a lot of opportunity to just look at who we are as investors. And as Emma said, take our sleep well at night factor into consideration and figure out how we want to approach. So everybody on the panel seems to agree unanimously that the Bank of Canada is not lying to us and is not about to do an about face. So we can expect a pretty significant increase in the interest environment, which means downward pressure on pricing, probably an extended period of price discovery in the market, a ton of attrition, a slow market, and potentially awesome opportunities to come with respect to good deals, but very possibly a longer period of price discovery than any of us expect, and maybe more years of uncertainty or of a weak market than any of us knows. So really, when it comes to the gentleman's question about locking in, I think Matt touched on a sentiment that I would share, which is that if you can assess a property that you already have or a deal that you're trying to close on and see that at the current interest rates, you're able to cover that with the spread that you're happy with, I don't see any reason that you can't lock in at that rate. And I've done it. I've carried fixed rate mortgages while properties that I accumulated later with variable rates because I had to secure them that way ended up going below the price of my locked in mortgage. And I didn't lose any sleep over it. If I'm missing out on a little bit of savings, but I know for a fact that there's no chance of the rates going through the ceiling and my deal falling through the floor, then I sleep like a baby. So with respect to interest rates in general, I think we're all expecting a couple more increases. I would think at least 1%. And with respect to whether or not you should lock in at these kind of rates, historically 5% is not particularly high. It's pretty normal. So if that's going to give you a lot of comfort, yeah, absolutely go ahead and lock in.
If I could just add to that as well, and those are great points by all three of you. I think it's also worth considering that interest rates might even raise higher than any of us are projecting, on the simple basis that we're still dealing with very low interest rates from a historical perspective. You look at the 40-year graph of interest rates, it dipped very, very low in 08, 09, and it dipped very low over the pandemic, but it's still quite a bit below that 40-year trend. And if the Bank of Canada is committed to getting a handle on inflation, and those inflation numbers continue to be stubborn, and we're still seeing that, like, there's still supply chain issues, still hard time getting product to market. I'm sure it's the same with all you. If you go to a restaurant, restaurants are busy, shopping malls are busy. There still seems to be an appetite to spend. If nothing else, it's an attitude that people might say, well, once interest rates come down, then I'm a buyer. And I think there is the possibility the Bank of Canada says we need to not just squash inflation, we need to squash the mindset that people will just get back into it when interest rates come down. They might want to see a recession for no other reason than they want to take the air out of those sails. So I think we should also brace for the fact that there could be the possibility of sustained interest rate increases. And to Abigail's point, I think it was Abigail, sorry if it was you, Emma, that mentioned if it makes you sleep better at night and you lock in a fixed mortgage and you can lock that in for 3 or 5 years, I believe it was you that said that, Emma, we're all humans. Like, there is that human element of yes, we all want to make sound, educated, sophisticated decisions, but at the end of the day, we all have to put our head down on our pillow and sleep at night. So if you did want to lock in, I'm on that camp as a lot of you are, that I think it will crest in early 2023. But if this inflation remains stubborn for longer than any of us suspect, I think that they're committed to raising those interest rates. So in my mind, and like, I think any sophisticated investor will kind of do some sort of sensitivity analysis on, well, base case is that it does go up in 2023 and start coming back down. Maybe best case scenarios, it comes down even sooner. But that worst case could be a little bit scary if we start building a pro forma and extrapolating data out for 5 or 10 years, because I really have no idea. My best guess is that we will see that interest rate crest, but the inflation is a wild story. And just that one quick thought on this as well. Like, it's mind-blowing to me that none of us really saw this coming. And we're in this environment now where we're all saying, yeah, interest rates are rising, and we're trying to make projections, whether it's just for our own personal investments or whether we're advising other people. But in 2020, 2021, they injected so much money, like the memes that went out of, like, the money printer Jerome Powell printing money. I saw that on every video of him just printing money. And it's true, they added so much to the money supply that I don't know if we'll really have a good understanding of how that trickles through the economy, possibly for years, if not decades. So that's what would worry me the most, is that this is an unprecedented time, and we're trying to use past models and say, well, in consumer sentiment, the people that we're talking to are saying this. I don't think that they really have a game plan on this. And not only do I not think that, I don't think they've had a game plan all along. I think they've missed the mark all the way through at how they kept interest rates near zero as they were printing a bunch of money, giving everybody subsidies. For them to not consider the fact that they're injecting all this money yet keeping interest rates near zero is comical to me. Like, that will have to go back as like one of the greatest failures in central bank history, that they injected a bunch of money but yet didn't try to get ahead of this. And Matt, you mentioned at the beginning, like, the messages were all different, whether it's from Tiff or Powell. First, it was this inflation is transitory, to, well, maybe this might last a little bit
that
longer.
was a criminal statement, almost, in my opinion.
Criminal. And to the point we're at right now, where they're saying we're going to raise it, we're going to have to do whatever we have to do. They knew all this. So for me to think that there is a game plan out there that any of us can adapt, I think you just need, and Abigail, I think you said it, to have a game plan. I think a game plan is so key on just being responsive and adaptive as things come up, because I'm pretty certain the next 2 years are going to be just as crazy as the previous 2 years were.
Yeah.
Well, Chad,
And
I agree with you completely,
we
but I'll
jump
say
over to
speak for
you,
yourself.
before we jump over to you, Josh, and then we'll get to Abigail as well, I can't help myself because I really want to build upon what you were saying there, Chad. First of all, Sammy jumped in here. Another 1 to 200 would be damaging. I don't disagree with you on that, Sammy. At the same time, I do think that that's likely the highest probability reality that we're likely to enter in 2023. And from my perspective, it's for a multitude of reasons. One, like the fact that they originally pushed the narrative of transitory inflation. I think that was them trying to massage and manage the economy and kind of, buy time. Like straight up, I think that was them buying time to try and figure shit out. But what we recently saw just occur in the UK in regards to Liz Truss essentially being forced to step down because the bond markets threw a giant fit. That is relatively unprecedented in my opinion here. And I think that, again, if they were to telegraph too strong of a hawkish sentiment, if they were to be like, yeah, this shit's going to 7%, like buckle up, get used to the new normal, I think that you would just see the equity and bond markets just puke all over. You would see complete capitulation from the paper investments. And I think that they want to try and boil the frog a degree at a time right now. And in fact, them coming in a little soft right now probably eases a little bit of pressure, right? Particularly when they saw literally what just happened in England. And I think that that's something that a lot of bankers and or central bankers, I should say, and a lot of politicians are going to be talking about for the foreseeable future, right? Everyone's focused, in my humble opinion, at least, on covering their ass here rather than necessarily doing what's absolutely right. The idea that we're going to have a Volcker that comes in and just doesn't give a shit essentially and is going to do what he thinks is right for the economy, I think that those days are almost past us at this point in time because there's just simply too much politicking, too much politics involved in this entire ecosystem when it comes to interest rates. And again, we won't know until hindsight happens. And I think that that's why you having a game plan is the number one lesson here in regards to interest rates. But let's jump to Josh and then Abigail.
Okay, well, I'm thirsty, so this comment's going to be brought to you by my sponsor, Premier Protein. Use my product code, I'm bullshitting, to save absolutely no money whatsoever. I agreed with everything you said, Chad, but the one thing I was saying was you'll have to speak for yourself with respect to no one saw it coming, because when the money printer was going brrr, I sold 2 properties in November, December 2020 and fully amortized my portfolio. So the comments I have on interest rates are pure speculation from a man who doesn't need to speculate, because I saw the writing on the wall, and it may have been a lucky guess or just me being a scared raccoon, but I got out of the garbage can before the truck came in.
If I could just add on that before Emma jumps in real quick, it's that Roosevelt quote, right? The it's not the critic who counts, it's the man who's in the arena. That whole paragraph that he has, and so wonderful quote. But I believe that unequivocally. It's like we can be like the figurative talking heads being in here right now and saying all these ideas and their guesses for the most part. We're trying to make educated guesses, but like you said, you're the one in the arena. You actually went out and did it. So I think as long as you're at peace with what decisions you make, and I'm a big believer, you just try to make the best decision that you can given all the information that you have, and provided that you do, then you sleep well at night. That could have turned out to be the play of the decade. And if you do, then you're going to need to write a book and then promote that on your OnlyFans page.
Yeah, there you go.
Let's jump over to Abigail.
Yeah, Chad, you said a lot of great points, especially the fact that I definitely agree with you when you're saying that they didn't have a game plan. Like, I don't think they really knew what they were doing, because if you guys remember, just a little bit before COVID actually happened, everyone expected that spring market to be the hottest market ever. Like, I had real estate agents projecting, oh my God, you're going to see an increase in this and that. And then COVID happened. And what's different about COVID is the fact that with history, we can see all the time the interest rates going up and down. But this one was different because people actually had to stop working. Businesses were shut down. Like, if you guys remember, we were going into Walmart and they were like, like they weren't letting us shop in places that are non-essential. That's something that it's not known to us humans. Like nobody can ever block that off. And I can only imagine our kids looking in the future and saying like, wow, you guys lived during those times. It's kind of crazy to think about, right? So for the government to even go in, start printing out so much money and whatnot, giving away so much money because they didn't know what they were doing. They didn't understand, like, how do we get our economy back? How do we help our people? But at the same time, not crucifying our economy because you're doing this now, but you're not thinking about the fact that in the next 2 to 5 years, how is this going to affect us? And this is what we're living. We're living the consequences of people not thinking through the whole plan, because the pandemic was something that was not something that they can ever predict. No one ever expected us to be like to have a freeze in the market completely. The streets are shut down and stuff like that as well. So there's so many things that are happening that nobody really understood, that now we're just facing the consequences of it. And I think that until we actually take time to kind of gather and make a game plan, like we were saying beforehand, we're not going to really see the correction that we want to see until like we actually sit down and say like, you know what, this makes sense. Like we need to do this, this, and this, and this, and actually analyze, okay, what are we doing too much by increasing interest rates by 200 basis points in less than 8 months? I don't think anyone's really thinking this through. So that's my issue with a lot of this, is like everyone's just making irrational decisions based on what's happening now, but not thinking about the future.
Well said.
Yeah. Again, I think there's a lot of variables. Normalcy bias is very real, right? And it's hard to not think about the historical low interest rates that we've experienced throughout my real estate investing career. At least I remember the first mortgage I ever got back in 2015. That was going to be the cheapest mortgage I ever got. I was definitely wrong. There were a lot cheaper days ahead. And in this current environment where we see, one moment banks talking about quantitative tightening and then immediately capitulating like the Bank and being like, well, we'll do a little bit more quantitative easing because the bond and stock market's getting beat up so bad. That's something that, again, we could see really weird distortions in our economy from those sort of policies, right? Like it's not impossible for me to envision a future where we've got quantitative easing while also rising interest rates. And it'll be two different reasons that they're choosing to make those decisions. And again, I think that the basis is oftentimes going to be political or versus anything else. But just real quick, Port City's very active in the comments. Same with Anil. Appreciate you guys jumping in and sharing your thoughts. And Port City taking us a little bit off topic here, but also Matt, ETH is ripping. Burr. So those of you that know, I do dabble a little bit in crypto, although there's only one Bitcoin, guys. So please, if you haven't looked into Bitcoin, do yourself a favor. But I think right now, obviously this is not financial advice. Do your own research. If I was an ETH hodler, I would be selling into this pump. Personally, I think that it will likely be May 2024 before we really see a real recovery in the next bull run. And obviously that's based off the thesis of the Bitcoin halving event. So I think right now, if I check my block clock, yeah, it looks like it's about May 1st, 2024 is the prediction. So if you guys want to go down that rabbit hole, really encourage you guys to do so. But we're going to keep rolling here with real estate. And Josh, I want to throw it to you and just ask a question, because obviously with these rising interest rates, as you mentioned in a previous comment, there's going to be a lot of price discovery going on. And when it comes to rising interest rates and price discovery, I can't help but think that Windsor's going to be very volatile, right? We've seen Windsor previously get beat down when the U.S. went through a major recession. What are your thoughts on the Windsor real estate market right now? And do you think, could we see another huge crash in Windsor real estate? And if that is the case, will you, aggressively buy? Are you aggressively selling? Where do you stand on everything Windsor?
Well, I think the easiest one to answer is that if there was a crash in Windsor, yeah, I would aggressively buy for sure. If these bloody tooth sharks didn't beat me to it, if you see anything that severe and aggressive these days on the tail of such a historical rally, there's going to be a buying frenzy like no tomorrow. But as everybody's pointed out, that's very hard to time. To give some real world data, my literal neighbor at one of my rental properties sold his duplex for $600,000 in late February. The single family home beside that sold for about $480,000. And that was its third time selling in a period of about 5 months, with each one going up by about $100,000. Well, I've been in communication with several real estate agents almost daily for the last few weeks. And my property, which is a legal duplex with 2 non-conforming suites with twice the cash flow, is currently probably slated to take quite a while on the market, even at $600,000. There would be no obvious jump at that. So comparing a purpose-built duplex, very outdated, that sold for 600,000 in February, we're basically at that being my hopeful top price today. So to go by the numbers, it looks like there was a really incredible spike between November and roughly March of 21, 22, where we saw peak prices around that time, about 30% higher than they were in October last year. And we're about back down to that number now. We're barely over our year over year benchmark from last year. So the biggest froth from the hysteria is gone already. That's a huge eraser of value. I expect we've probably got a good 10 or 20% to come and wouldn't cap it there. It's hard for me to imagine there being an outright crash in a market like Windsor, both because of the pent up provincial and national demand that Emma already talked about, and also because of the specific enhancers that are happening here with respect to our hot job market and some big players coming to the city with the bridge, Stellantis, and the big three rallying strong around a couple of extra shifts. So I think Windsor's probably going to be as stable as anybody, but we've already seen a hell of a lot of value come off. We'll probably see quite a bit more to come. And I'm more inclined to buy myself.
Yeah, appreciate that insight, Josh. And now a question for Emma and Abigail in regards to Toronto real estate. You know, we're seeing all sorts of different narratives come out in regards to what's going on in Toronto these days. I'm going to pull up a couple quick stories here. The first one from Better Dwelling. Toronto is the biggest real estate bubble in the world, Vancouver 6th. This was from October 13th. So we've got global real estate prices are bubbly, especially in credit bubbles. Global real estate prices are growing at one of the fastest rates in history. UBS analysts found prices in 25 markets tracked for bubble risk have increased an average of 10% over the past year. It was the strongest increase since 2007 during the last global housing bubble. And just for perspective here, this is the UBS global real estate bubble index. So we've got Toronto at 2.24. That being said, we also have the narrative still that Toronto's real estate, while it's slowing, it's still actually North America's construction crane capital. So I'd love to hear from both of you guys. What are your thoughts on this? What do you make of this, right? Are we going to see a slowing in regards to construction and building in Toronto? Or is Toronto such a robust international market? Is it truly the world-class city that at least the hometowners tell us? And will just be able to weather any sort of volatility right now?
I'm happy to go first.
Okay, no worries.
I think there's a couple things. So if we look at the, I think the article is funny. Sorry, I don't mean to say funny. It's just one of these things where if you actually look back at the UBS, it's an annual report that they release, and for lack of a better term, we've been on the podium as a front runner, I think, since like 2017. So we've I think this is our second year of leading the race, but to me, I'm like, oh, it's not really anything new. Like they've been saying this forever. And I think there's a couple other things. If you actually look into the data of the actual report, you'll notice that the actual data that they pulled for that particular report was pulled in April, I believe. So I'd actually be curious to know if they looked at it globally now, would we still be the leader given the fact that we've seen prices come down, I don't know, probably 13 to 15% since the time that they actually pulled the data? I don't know. I'm not saying that we aren't in a bubble, by the way. I'm just saying that I think it's sexier on paper than it is in actuality when you look back over, the last 5 to 7 years. And then in regards to building, I mean, we've obviously seen a ton of cancellations in terms of projects already this year. I think there's been over 4,000 units that have been canceled, at least since the last time I checked. So it's probably significantly higher than that. So I think we're somewhat kicking the can down the road, given how aggressive our immigration targets are for 5 years from now. I think it's like, I think we run into the same problems in a couple of years from now. It's just like we have a little bit of treacherous and volatile market over the next little while. But I mean, I hate to be like the person to bring up like supply and demand, but like I think we're I think in 5 years we have the same conversation that we had, given the immigration targets. So it's tough to say. Do I think there was a lot of speculation and money that was pumped into the market? Like, yes, I will be the first person to say that. I've never been a huge proponent of pre-construction. Like, I've actually never sold a pre-construction unit in my entire life because I always found that it was somewhat speculative. But I do think we have tremendous immigration targets for the next 5 years. We're looking at almost 500,000 people a year, and all of those people need places to live. So it's tough to say. Again, I don't have a crystal ball, but I do believe in the long-term vision of Toronto real estate.
Yeah, appreciate that insight. Abigail?
Great points, Emma. Like you said everything. I'll just add a few more points that I have. Like just piggybacking off of what you're saying in terms of Toronto real estate, and also immigration. Like the targets that we have for immigration in comparison to how many houses that we have built right now and what are being built, they're not comparable at the moment, right? So we know that we need more. So I can't sit here and think that, okay, like we're going to stop building, or there's not going to ever be enough home. I mean, there's going to be enough homes. We're going to get to a place where the supply is going to be too high for the type of demand that we have. Like I can't see that at this moment, and especially because of how long it takes for condos and houses to be built, the zoning issues that we have. I know recently they're talking about changing the zoning issues that we're having. Doug Ford was talking about that. That may help, but that's not going to solve the issue completely, right? We don't have enough spaces for people. Like even right now, we see how the rental market is just going up insanely. Like just the other day, like every day what I do, I like to get MLS listings of the rental like leases that are happening. And downtown Toronto, you're seeing 2 bedrooms go for $4,000. That's not sustainable. People are gonna realize, hey, like I know right now I don't want to buy a house anymore, but I don't want to rent and pay somebody else's mortgage for $4,000, regardless if the interest rates are 4%. I'm gonna try my hardest to get a house, and that's the thing that I feel like a lot of people are going by, is that they're waiting. They don't want to get into the market, or they can't get into the market right now. But once those rents go so high to the point where it's like it just seems like it's unbearable, people are gonna do whatever it takes to get a home in itself, right? So I can't see the demand not being there right now because the supply is too low in my eyes. But that's just my perspective. And like you said, like I don't want to sit here and say that we're not in a bubble per se, or like the housing market is not going to drop even further. It could, and definitely because the interest rates are going up. But I can't see our detached homes that are selling for $900,000 hitting $300,000 or $500K right now. But that's just my opinion.
Yeah, appreciate that insight. We'll jump to Josh quick and then hit Emma.
To highlight a point that you both already made, our immigration targets are quite aggressive, looking at roughly 2 million new Canadians in the next 5 years. And a very interesting thing to highlight with that is that the trend for immigration to Canada is not one where feet land on the ground evenly across the country. If you think of our municipalities as a bell curve, they all immigrate to the tails on one side or another in terms of the cost of living and the opportunities. So everybody's either going to the cheapest city as quickly as they can, or they're going to the best earnings opportunity and paying the price accordingly. So everybody ends up in the Windsors and the Torontos, or the Winnipegs and St. John's and the Calgarys or Vancouvers. Meaning cities like Toronto that are economic powerhouses, historic strongholds, and population centers that are just irreversibly large. We're not about to see a flight from that city. So one other consideration with respect to immigration is that we've already got pent-up demand from COVID and all the additional restrictions and delays that happened then. And now we have the added demand of the international instability caused by the conflict between Ukraine and Russia, meaning that to the degree that people flee those areas and even catch some spreading fear in surrounding regions like Poland, we could see a lot of people increasing immigration here voluntarily that weren't planning that in the last couple of years. To the extent that food shortages happen internationally, we could again expect Canada to step up with a humanitarian response. So I think our immigration targets that sound pretty aggressive historically might actually prove to be modest compared to what we end up doing in 5 years. So if we see the trends that we expect with 2 million new Canadians, I think that speaks for a robust market in Toronto, as well as quite a lot of Canada as well. That pent up demand for the real estate market could easily come back roaring.
Yeah, I agree with you, and I just wanted to make reference to a couple of comments about Alberta. So I actually agree with you guys because there are a lot of born Canadians that are emigrating from Ontario to go to Alberta, given the cost of housing and whatnot. But if we look at international immigration, you know, typically Calgary is not the number one spot. If you actually look at, of the 421,000 immigrants that we have coming to Canada, I think it's like 45% of them end up in the GTA to start, right? Now, that doesn't mean that they're going to continue to stay there, but if they move there, they need a place to live immediately, even from a rental situation. And then when we take into consideration, um, the type of immigration that we have, the bulk of the immigration that we have are skilled laborers. Like, we are trying to attract people that are going to boost up our economy, that are, whether they're tech workers or software engineers or whatever they happen to be. We are trying to attract skilled laborers, which typically have a decent amount of income and eventually become permanent residents, and once that happens are no longer subject to foreign buyers tax, and those people eventually end up purchasing homes, whether it's in Toronto or whether it's somewhere else in Canada. It's just statistics that many of them do end up in the GTA. So, am I bullish on the Toronto real estate market long term? Yes, but I also agree with you that from a traditional affordability perspective, as someone who was born in London, Ontario, Calgary's looking pretty damn good in comparison to Toronto at this point in time.
Yeah, appreciate the insights. Let's jump to Abigail and then Chad. I'd love to hear your thoughts on Alberta.
Just to add one quick thing that Emma was saying in terms of like immigration coming in, like we also got to think about diversity, right? The type of people that are coming in, what are they familiar with? Who do they want to see around them, right? Those are the areas that they're going to gravitate towards, naturally speaking, right? So not really familiar too much with Calgary as much so, but I know it's not as diverse as the GTA, right? So a lot of people, like you said, Emma, are going to make their first step to be in Toronto, whether they end up moving or migrating somewhere else eventually. But a lot of people's first thought when they think about Canada is Toronto usually. So for us, we still going to have the influx of people coming in here. So yeah.
Yeah, Chad, do you mind jumping in and sharing some perspectives on Alberta?
Yeah, and those are all great comments. So I've born and raised in Alberta, and I still call this place home. And I've got two different perspectives on it. I suppose one from someone that's looking at it from a personal standpoint on where they're going to live, and then another from an investment standpoint on where they're going to invest at. And I think there's different evaluation metrics that people look at. For a pure quality of life standpoint, I'm a big believer that anywhere you live, anywhere in the world has trade-offs. So there'll be positives, and then there's also going to be trade-offs that you have to make. In Toronto, the trade-off is price. It's just very expensive to live in Toronto. It's very expensive to live in Vancouver and other metropolitan cities. I love both cities. I've been to both cities numerous times. It's just expensive. You get to live in that metropolitan area if you're willing to pay the price. In Alberta, the price that you have to pay is a long winter. And having lived here for 42 years, I know firsthand how long these winters can be, and they are tough. But on the other hand, that's the price that you pay in exchange for it. Everybody has an opportunity to live in a nice house and go on holidays and have a good quality of life, and taxes are cheap, and there's a lot of positives. There's a reason I've lived here as long as I have, but I also recognize that it's not Vancouver or Toronto, but the trade-off that I've just been willing to pay is those cold winters in exchange for everything that it comes from. That's from a personal standpoint. From an investment standpoint, I'm just a big believer that everybody's going to go through some mental exercise in developing their investment thesis on what they want to put their money in. That can be deciding to just stay liquid and stay in cash. Perhaps they buy bonds or treasury bills, whatever they buy. Everyone's going to go through some exercise of determining what's the best thing that they should be putting their money in. I'm very bullish on industrial real estate, but I've also spent my entire career getting to know it. It's been something that I've developed over time. I don't recommend industrial real estate for the majority of people because it can be very overwhelming, whether that's in Alberta, where I am, or anywhere in the world. Real quick story though. I just wanted to bring this up real quick. There's a guy named Amancio Ortega, and I don't speak Spanish. I probably butchered his name. I'm pretty sure there's a rolled R or two in there. He's the guy that started Zara. He just bought $900 million worth of industrial real estate in North America. And this perhaps kind of rounds out how I think about investing from the standpoint it's the short-term aberrations can be significant and they can have a real impact. But the weighted average lease term on the leases of the properties that he bought, and it's Amazon, Home Depot, big companies that are like these big distribution companies, is 8 years. So I'm assuming that he fixed his debt relatively similar to that, and the numbers made sense for him to do it. In my mind, he goes and buys properties that have long-term tenants in place, and he's fixed his debt. They're Fortune 500 companies. I would like to think that if I was in his shoes, he's probably thinking, I really don't care what happened for that portfolio anyways. He probably doesn't really care what happens in the next year or two or 5 years for that matter. He might care as he approaches that 8 years when those tenants start coming up. But I kind of just go back to that whole point is that we really don't know what's going to happen in the short term here. And Matt, I really want to compliment you on how you've let this conversation evolve, because I'm a big fan of Abigail, Emma, and Josh on here on your perspectives. And just real quick tangent, but I promise I'll bring this home. My big problem with media is that there always seems to be a very stark, opinionated person. So they'll come on and say real estate prices are going to crash 20% next year. Well, possibly, but there's no way you could know that. Otherwise, you'd be the richest person on earth. You'd be shorting everything you could get a hold of. You'd be buying when you think that it's going to go up 20%. Nobody has a clue. But what I'm a big fan of all three of you on this is that we're all just trying to say, well, there's all these variables that come into play, whether it's immigration or someone looking at Toronto because it's a world-class city. We're trying our best just to come up with an investment thesis on saying the short term we really don't know. We're just trying to make guesses. But if you're bullish on long term, I still don't see a better investment vehicle than going through real estate. So I'm honored to be on this show and be with such a esteemed panel of people that are saying it's not dropping 10% next year or going up to 10% because we really just don't know. We're going to have a game plan. We're going to try our best to adapt and respond to the situation as it comes up. But it's really impossible to say Alberta is going to be a great place or Ontario is going to be the best place or perhaps even moving it out of Canada. None of us really know. We're just trying to do the best we can with the information we have available.
Honored to be here with you too, Chad.
Yeah, I definitely appreciate that sentiment. And I think that probably is a great segue into the last question I'd like to ask each of you, which is just what's next for you on your real estate journey? And we'll maybe just kind of go in order here on my screen. So Emma, what's next for you with real estate? Are you selling something? Are you buying something? Are you just hodling?
Yeah, I'm definitely looking to acquire, and I just really wanted to echo what Chad said. Is like I try to, I think I've realized throughout my career, like this can be a very complex thing, and I think as humans, we love to make shit so complicated, and at the end of the day, we usually have the most success when we just come down to a couple simple things, and so my whole strategy for myself and for my clients is buy AAA quality real estate with great features that people are always going to want and love to live in, whether it's a condo and it has this unbelievable view that is not going to be obstructed and it has parking, or if you live in a great school district, or if you have a ravine lot, like just buy unreal real estate at the best possible price that you can with a long-term strategy and make sure it has features that other human beings are going to be like, I wish I had that. And I think it's a pretty simple model to follow. And if you can buy that at a discount, which I think there are really good opportunities to do right now, as long as you can afford to make the payments, you feel comfortable, whether you're, renting it out with the rents or if you're buying as an end user, you're not going to lose your job given the, current state of the economy. You could float the payments and you buy something with, AAA quality features. I think in 10 to 15 years from now, you're probably going to do pretty well. And that's my whole kind of theory and thesis on simplifying real estate. And it's worked out for me and my clients so far. So I'll let you guys know in 15 years.
Awesome. Appreciate that, Emma. Chad.
I love it. I could completely echo what Emma said. Buy good quality real estate. Make sure you're not leveraged to the point that that you can't afford to do it if interest rates do rise higher than any of us are anticipating, or if there's a recession. Buy responsibly, but buy high quality real estate, residential, office, retail, industrial, whatever your preference and appetite is. Just buy great quality real estate, simplify it, take a long-term approach. Emma said it way better than I could.
Awesome. And then for you personally, Chad, like I assume closing this $6 million deal is the next thing for you.
Yeah, we are on pace to do it. We've already done all of our due diligence. We're waiting on one lease to be signed, so we expect to close on that. My goal all along has been to try and add one property a year, and I've been on pace with that. This would actually be the second one we've added this year, so even a little bit ahead of schedule. But I'm a buyer all the way through. I think that there is going to be downward pressure on prices for the next 6 months, so I would reevaluate my pro forma up more diligently than I perhaps would have when they're printed money like it was going out of control. But I'm still a buyer. I will keep buying as much as I can at numbers that make sense.
Awesome. Appreciate that. Abigail, what's next for you on your real estate journey?
Right now, like I'm going to tell everyone, like tell my clients, tell myself, having a real estate action plan. And that's for me, that's what I'm doing. I'm always constantly revisiting my plan and my action plan that I have. Currently, I do have my primary residence listed for sale. Only reason why is because I want to take this time to save more money. I have an opportunity of going to go live back with my parents, which is great. Going to do that, save some more money, and then have money so that when that time comes for me to buy, like Chad is saying, I'm definitely a big believer in buying. I can buy what I want to buy and be able to, make a good investment for myself. So I'm really about just being able to save as much right now, bring down my expenses, and make sure that I'm prepared. Like I was talking about beforehand, prepared for when I want to actually like just shoot and then get what I need to get for my next property that I'm looking for.
Awesome. Yeah, I love that. I think it's always under your control what you spend. You
Yes.
maybe sometimes can't control what you make. You sometimes you can never control what happens in the greater macro economy, but you can absolutely always control what you spend. And I think that this is a great opportunity for a lot of individuals to test themselves, to maybe get outside your comfort zone and start challenging yourselves to try and find ways to, you can still maintain even the same quality of life, but at a fraction of the cost, right? And that's something that both myself and Mike Rosart are huge proponents of. And I think in these sort of volatile markets, it's a stronger argument than ever to really just try and tighten the belt a little bit, save where you can, because again, I think there will be opportunity. Not that there isn't opportunities now, but I think there will even be better opportunities in the future. And why not put yourself in the best position possible to take advantage? All right, Josh, what's next for you? Oh, you're muted, Josh.
I was playing charades and wanted to see who could guess what I was saying. My recent experience in the last few years is actually probably a great perspective builder for people who haven't done a ton of investing yet. We've been discussing throughout the show the threat of rising interest rates in the range of 5%. And in reality, up until this year, I didn't even know that people were playing the private money game as a default approach to aggressive real estate investment, meaning people are routinely taking out loans in the vicinity of 10%, depending on how leveraged they are. They even go as high as 12 or 15 and get into massive deals. So, I mean, Casey Wong on this channel has illuminated a really powerful history of buying massive properties at terrifying interest rates and made out like a king on it. So for me, in 2020, I was coming in to get financing as a very conservative shoe-in for the deal and got left at the altar because of the changes that happened during COVID. So I ended up having to take my first private loan to cover that. And I got a loan at 10%, interest only, paid a lender's fee up front to get into it, and then had to do the legals on both sides. And I was sincerely grateful. And that was a wake-up call for me. So having an amortized portfolio today, one of my next moves is exploring the world of private finance. The reason that I was talking about listing my property is because at the point that my windfall is going to be the entire value of the house minus a couple fees to close on, I can turn that over and put it into a private loan at 10%, collect a lender's fee large enough to cover my tax burden for the year. So I can actually generate more cash flow from selling that house and lending that out privately than I can through the home. And then here where I live in another one of my projects. I'll be exploring a refinance, even at high rates. or more realistically securing a HELOC on it so that I have the opportunity to leverage that. And that's really the name of the game for me going forward. It's partnerships and leverage. I've done everything alone. I've done everything with my bare hands. I've done everything as safe as possible. And at this juncture, that's stupid. So I'm in the cash flow tribe. I'm meeting people every day. They're talking about real opportunities that they're capitalizing on already. I want to use other people's skills, other people's time, other people's money to pair with my own and synergize and start redeploying the money that I've saved up with this FIRE method and see how much more cozy, how much more luxurious, how bougie I can get just rallying the nest egg I've already put together.
Awesome.
Get my nails did with it.
That sounds great, Josh. And I'm going to quickly hit one last question here. I'll just answer this in my opinion. When a multifamily building barely makes a 1.1 DSCR due to today's climate and rates, what is the best way to approach a seller who is $1 million overpriced? I think regardless of whether a seller is overpriced or not, my number one approach is always going to be creativity, right? And I think particularly in this market where maybe you think that the seller is a little too sticky on their price, maybe they're thinking about the price they could have got a year ago, but they still want that price today. It's really going to come down to terms, right? That's all there is really when it comes to real estate. You've got two levers, price and terms. And so if there's no movement on that price whatsoever, we're going to need to really push on the terms. Naturally, my mind starts to drift towards a vendor take back mortgage. Is there a version where you can give them their price? Maybe you're going to overpay for it, but the terms of the mortgage are going to be so attractive to you that you can either improve the cash flow of the property, or you know that you can hold it for an extended period of time until your investment thesis plays out. Oftentimes when we were buying large apartment buildings, we'd often find that we were completely at loggerheads with the seller in regards to where we want to land with price and where they want to land with price. And that's the moment that we'd break out the VTB, right? And so again, you can get very creative. If you've never really explored vendor take back mortgages before, we've got tons of videos on the YouTube channel. But again, things like interest only payments, right? I've set up mortgages before where you just don't make a payment for 6 months and essentially interest is deferred, or there's no interest for that 6 months. It's 0% interest. Again, there's a lot of creative strategies you can look to implement as a real estate investor. It's just down to you to figure out what's the win-win for you and the seller. So really understand the motivations behind your seller, and that's going to allow you to put your best foot forward, but always stick to your fundamentals and your investing principles. Far too often, I see people compromise because they fall in love with the deal. They want to put numbers on the board, right? They told themselves they were going to get 24 units this year. This is a 24-unit building, and so they're going to compromise on the fundamentals in order to make sure that they can, prove to themselves that they got that deal. Always stick to your gun when it comes to your investment strategy and the fundamentals there. And again, just appreciate everyone joining us on the second episode of the Roundtable. Really appreciate it, guys. Make sure you give them a follow on social media. And we'll be back next week, same time, same place, 8 p.m. Eastern Standard Time on the Canadian Real Estate Channel. And again, just appreciate everyone hanging out with me. And I hope you guys enjoyed this video. Thanks.